important. Looking at your down payment, how can you save up for your down payment? I've seen someone over these 6 years, he came to me and said, Habiba, I want to buy a mortgage. I want to do a mortgage. I said, then that's fine. Without 0 down payment. And I said, how do you want to do it? Oh, I can take from my line of credit. It's a no. You cannot service a loan for a loan. A mortgage is a loan. And saving for your down payment, you can use your savings. Maybe $25, even $1 counts, right? You can do a gift. Now CMAC said you can do a gift. Your down payment, all of your down payment can be a gift. It must be an immediate family member. And again, you can use your RRSP. You can use what we call first-time home savings account. You can use that. The more you put in there, the more it increases. Another thing is planning. And another thing is God says this is the time for me to do it. It is not about my friend just bought a house. Your friend has a mortgage income, household income maybe around like 150. And you're comparing yourself that has maybe 60,000. Don't get me wrong. Not that you cannot buy. You can buy. But what you're going to buy is different from what your friend bought already. But your friend has been saving towards the down payment. A client called me yesterday and said, oh, I have so X amount in my RRSP. Oh, I have in my savings account. You can see that he is ready for it. He's single. He is single. He said, I've been saving for like 2 years now, and I just want to do this. And this is the time. So it's not about jumping. I do always tell someone, I said, you want to go into the pool. That is what I usually do. I'll first test the water. Is this cold or is it warm? Can I jump into it? So I want to feel before I jump. Because if I don't do it right, definitely I will hear it at the back, at the end of it. Another thing is, okay, I talked about the RRSP. RRSP, you can use it as a first-time home buyer. And you can pull money out, the one that you have already saved. But it's not taxable. But immediately you pull that money out, you have 15 years to pay back. Not that you're not going to pay back. There is no free money in Canada, right? You still have to pay that money back. Until you pay it back, you can still take it out and use it for your down payment as well. I put the bank statement here. Why did I put the bank statement on that down payment? There's something we called anti-money laundering. You know, Nigerians, we will tell, I've seen it a lot. They will just come and say, yo, I just moved money from Nigeria and I drop it into my account. Yes, that is fine, good for you. But you cannot use it for your down payment. It has to sit into your account for 3 good months before you can use it. Because why? Anti-money laundering. They want to know that if actually this is yours, it will stay in there. They want to see that I did an application. It's so weird. There is what we call LEMFI and PASA. There's money movement from Nigeria to here. Yes, we do that a lot. I have it too. But the moment you want to use the statement of account you want to use, if a lender sees LEMFI, PASA, or whatever in it, they will question it because they want to know the source. We went as far as going back to Nigerian account just to prove the source. Some people will pull from their line of credit and dump it. No, it's not. But I do tell you, you can still use your line of credit. How can you use your line of credit? If you put a line of credit into your account this month, okay, and you know that your possession is going to be in December, you can use it because the month that you're taking possession in December, now the month that the lender wants to see, because you will start working on your application process around, let's say, maybe October. Now is April, right? So by the time we now use June, July, August, or July, August, September bank statement, that will sit into your account already. But guess what? You have to pay that back because it's still going to tell on your TDS. It's still going to tell on your liability. But we're still going to talk about that. So please, when we are moving money from Nigeria, be mindful. Always remember that that month will not be used. And there is this thing, I will shock you. You know our ajo now? Our ajo is money laundry. Do anybody have a source for ajo? Maybe, I don't know. Do you think there is a source for ajo? Anybody? No. Source for ajo, do you know? A source for ajo means, we are maybe 10. We put ourselves together. And, okay, this month is your turn to pick. That month is the other. There is no source for it. So how are you going to prove that to lender? But there is a way. You know Nigerians now, we are smart, eh? There is always a way. What I usually do, I said, tell me if you're going for ajo. We will use that ajo as a gift. You are my sister, right? And you are my brother, isn't it? I will say, yes, now. Chooks is my brother. He's my perfect immediate brother. Naim, is my egbo, right? So that is how we see gift. Gift must be a family member. They will ask us to fill a form for gift letter. Whatever you put in there, just say it's my sister, it's my brother. So in order for that application to go, and it has to come from him. It has to come from Chooks because he's the one giving me. So I will move my ajo, or I will tell them, don't put my ajo into my account. Send it to Chooks. So that Chooks will now issue me, maybe, what is it called? A bank draft. Thank you, sir. He will now issue a bank draft for me and put it into my account. Then I'll just write Chooks, even though I'm Yoruba and his other, we are brother and sister, isn't it? Can someone tell me, I just want you to guess, who can guess the best language I love to hear in this industry? Anyone? Just one word. Anyone? Guess. I want you to guess. I want you to guess any word. Just one word that I love to hear when it comes to mortgage financing.
Approved.
Oh my goodness, thank you. That is it. Approval. Approval. Because approval, money in my pocket now, isn't it? Right? And I'm putting a smile. I'm helping you to achieve that dream. Even though that is not your dream home, at least it's a starter home. And I always tell people, a starter home, you just want to use it as, okay, to upgrade later. But it's still a home that you believe that I can sleep. So when you're looking at, there is something we called a pre-approval. Most people always go to the rate or the real estate agent before seeing their mortgage broker. Why? Because they don't have a deep understanding. Or sometimes they'll just go into their bank, bank and said, okay, I want to get a mortgage. Yes, that is fine and perfect. But pre-approval will tell you, what is your income? What is your household income? Household income. Funny enough, there is this, I like to explain with most of my deals. There is this client, she called me last week. Self-employed. Husband is working, 75,000. Child benefit, like let's say 13,000, 83,000. And she called me and said, Habiba, I want to get a mortgage of 900. I said, what? With 83,000? You're kidding me. She said, no, but I can add my self-employed into it. I said, yes, but at the same time, how do you want your income cannot shoulder it. You want a mortgage that comfortably, if one income can pay off your mortgage and debt and utilities and like that, you're perfectly okay. And the other income, maybe the wife's income, go cruise now. Isn't it? You don't want to be in that debt. One client just called me not quite long. And I'm so, in fact, I did their mortgage 2019. Now it's time for them to renew. Amortization 25 years. Guess what? They have dropped their amortization period to 12 years within 5 years. Indians pay their mortgage like this, but we sit in our mortgage. It shouldn't be. So pre-approval actually means, what can your income afford? What can your household consume? They're going to see what are your debt ratios. So many things to factor in it to do the pre-approval. So what are the documents needed for pre-approval? Definitely you need your identification, your verification of employment, your proof of assets, which means your down payment, your credit history, your debt statement, rental history, and references, gift letters. So those are the things we put together in order for us to get how much you can qualify for. We're still going to talk more about it. Under this slide, I won't talk too much because Chris is going to talk to you much about that GDS, TDS. How does it work? What actually makes my pre-approval? Chooks is going to take us in depth about that. And again, Chooks is still going to talk more about the credit aspect of it. You see, people sometimes we are not mindful. We are not mindful of the way we do our credits. The only time people see, the only thing they have in their head is, I want to buy a house. My friend just got a house. But what are the other factors to consider? Are we thinking about the right thing? Or are we just thinking about out of our emotions and said, oh, I want to do it. But is it even the time? So there are a couple of how you can check your credit score. You can go to Equifax or you can do TransUnion. But most lender goes by Equifax. So I usually tell people, either you can download like a Borrowwell credit. Borrowwell credit, it's more closer to Equifax. That will give you an understanding of your credit. So you will have done like, okay, my mini assessment before you want to jump into it and said, okay, we are actually ready. So it's better to you can pull your credit from Equifax. It's just maybe like $9, $10, $15. So that will give you the opportunity that, okay, I am ready. A guy called me and said, self-employed. You know, unfortunately, most self-employed, they mess up things a lot. I did an application for a rater. Our credit was around like 500 and something. A rater. So it doesn't even matter whether you are this or that. Those anymore, they are the worst, I tell you. They utilize their credit as if, yeah, I don't need it. But if we start watching our credits now, so many people tell me, don't pull my credit now. Yes, it's good, but at the same time, you want to see. If you don't pull, you won't know where to just fix anything that needs to be fixed. So don't be afraid of pulling credit. Pull it yourself so that you will know that I have to work on this. Okay? So you can do Equifax or you can do TransUnion. Then there is what we called mortgage default. I'll do a quick math. You have a mortgage of $300,000 and you want to put a 15% down, 15,000, 5% on that mortgage. You can only go by 5%. The difference there is 285. When you minus 15 from 300 is 285. But there's what we call CMAC. Most people will tell me, how come this has added up? CMAC will tell you, no, we're going to insure your mortgage for 25 years, and you have to pay for that. It won't come out of your pocket like your down payment, but they will put it back on your mortgage. So for a 300,000 mortgage, it's around like 11,600. So what you need from a lender, it's around 296,400. So that is what we are presenting. That is where you're going to pay your principal and your interest. So it's not as if, oh, it's 285. I get that a lot. I said no, because they're still going to insure that mortgage. So, but it's not coming out of your pocket, just like your down payment. And remember, it's not only down payment that you needed. You needed a closing cost. Closing cost is 2%. And that is when this is for CTO, okay? It goes to your land transfer title. They want to check that is your mortgage not encroach with another, with your neighbors. So that has to be done. So we have 3 types of default mortgage insurance. We have them as the CMHC, we have Genworth, we have Canada Guarantee. So it's either one that can approve your mortgage. If these people did not approve your mortgage, a lender would not. It has to pass through them because you're doing below 20%. Even if it's 19.99%. Funny enough, I was doing an application and I just put 19.99. Guess what? About a mortgage of 400 and something, they still have to pay like 6,000 something for the CMHC. So if you have the 20%, fine. But if you don't, you still have to pay the CMHC. Fixed rate, variable rate. This is where people run. I want the best rate. There's so much rate when you're looking for the best rate. They will not tell you in bank. There is something we called standard rate. There is something we called rate options. There is something we call flexible. But because you don't have an idea of it, standard rate, let's say standard rate is around like 5.14. And rate options is around like 5.09. You will want to take the 5.09. Who will want to take the 5.19? Nobody. But you want to go for the 5.09. Because why? It's lower compared to that. But they will wait for you. Where? If you want to break your term, your penalty will be higher. Someone came to me and said, oh, yes, I need to. You know the time of we have the 1.44 thereabout. And they were like, okay, I want to break my term right now. 6 months, they charge him around $4,000 for 6 months to end the term. I said, there's no need for you to do. Just leave them. Unfortunately, you don't want to pay that. And it doesn't even make sense to me because it's just remaining time is just 6 months. So why would you want to pay $4,000 like that? So that you have to be very, very careful. Variable rates fluctuates. But fixed rates, you pay that for the course of your term, either 5 or either 3 years term. This is my favorite part. 10 commandments of a mortgage. We see so many people that does these mistakes. Don't change your job. Don't change your job or don't quit and say, I want to become a self-employed. Self-employed, they need 2 years history of that self-employed. So there is no need for you to quit your job and say, I want to do it now. Someone wants to take a possession in May. She quit her job early March. And I said, how do you want to do it? And it's a new build. And you have to bring the mortgage. They need their money, so you have to pay back. So don't change your job. Don't buy a car. Car loan kills application. They will tell you, no, every car dealer wants to sell the car. But they will not tell you when you want to buy a mortgage. What they will say, oh, it doesn't matter. I've got that a lot. But by the time you buy a car before your mortgage, it might drop down your qualification by 80 to 100,000. So there is no point. Or because we don't know. Because we don't know. There is another financial institution that will tell you, okay, we will take this car from you. In order for this application to work, I've done it for a couple of clients. In order for this application to work, and I'll tell them, can we switch this car loan to your family member for 7 months? But one, definitely the payment is going to increase. So if we can switch it, then that is fine. But it has to start from a car from 2017. So if it's below 2017, then it's going to affect your application. So don't buy a car before your mortgage. Then don't use your credit card. I've seen people owing over the limit. It ruins credit. Please, don't. And they want you to stay on 25 utilization, not 95. I do that a lot too. Sometimes I'll just exert 2,000. I'll just maybe it's 200 on top of the. No, we shouldn't. We have to stay like in a card limit of, let's say 1,000. Use 250 and let 750 be in there. That helps your credit. Then don't spend money that you have put aside for your down payment. Don't omit debt or liability from your loan application. Don't buy furniture. This will happen to all these new builds. They will now go, oh, Bricks is doing sales. I need to buy my appliances right away. Yes, but you bought a gas, but you didn't have a car. Does that make sense? It doesn't. Unfortunately, I know there is always a sales on it, but there's always will be a sales. So now get your key and start looking. Or check with your mortgage broker and said, can I go shopping now? Anything you want to do, ask your mortgage broker, is it the right time for me to do it? Is it the right time for me to get this done? Oh, sorry. Then do not, then checking credits here and there. TD, you go. Scotiabank, you're there. Everywhere you're there. But if a mortgage broker pulls, we pull your credit once. And we can shop around with 40 different lenders. Instead of here and there, the more you go, it hurts your credit. Like I said earlier, don't make a large deposit without checking with your broker. Let her know what it's all about. Then don't change your bank account. I've seen that. People will just be like, I just open another account. Why? Why do you just open another account? Because you want to do a mortgage? No need. Leave that account that you've been using for years because you've already created, they already know you in that bank. So don't just go to a new bank and say, because I want to start saving here. Start saving there. Wherever your, your salary goes and you've been using for a year or two, just leave it there because you have history already. Then don't co-sign, please. I've seen this a lot. Don't co-sign for car loan. Don't co-sign it for anybody. It hurts your credit. Apart from credit, it will not allow you to get it. Because if you co-sign for someone, I have someone right now, she co-signed for a car. Unfortunately, they can't buy a house. Because that is going to go into their debt ratio too. And it's going to hurt that. Amortization. You can amortize your home for 25 years. But the beauty part is there is a law that is coming now. You can do it for 30 years. But that is going to start in August. So that will help in the sense that although you'll be paying more interest, either you do 25 or 30. So by then, it will help with your service ratios. It might reduce because you know that our interest rate right now is kind of like up there. But it will stretch your payment. So amortization can go for 20 or 25. And another thing, when you want to, like I said, my clients paid from 5 years and down to 12 years. You can do accelerated biweekly payments. You can pay additional on your principal, not on interest. So that helps with amortization. Another thing is people will say, oh, if I had, your term is locked. You can't change your term for 3 years or for 5 years. It's already locked. And by the time people will say, oh, I'm adding into my principal every month. Yes, good for you, but it will not have any effect on what you have locked in already, but it will have effect on your amortization. So by the time at the end of your 5 years term, there is different. You now see the remaining amortization in it. So I think I'm done with my slide. Thank you so much, and I'll call over Jukes.
Good afternoon, everybody. Once again, I will say good afternoon, everybody. Once again, Pastor, thank you very much for giving us this opportunity to do this information section for the church. And my senior colleague has said a lot about mortgage. Thank you very much, Abibat, for the entire presentation. For me, I will be presenting basically about the managing debt effectively for mortgage. So if we all remember when Abiba was talking, it was basically talking about how we can manage our debts. And it's very, very important. It's one of the major factors we need to look into when we are taking our mortgage or any kind of facility that we want to take. Our debt is one key factor in this country. So managing debt effectively is crucial for mortgage eligibility because it directly impacts individuals' financial health and borrowing capacity. Here's why effective debt management is significant for mortgage eligibility. So I want to tell you all that the impact that mortgage debt have over the amount that will be pre-approved has a lot of impact. And this is the reason. One of the factors they look at when you want to apply for mortgage is your debt to income ratio. So that's where the earlier speaker was saying that when we are presenting, so that's where the earlier speaker was saying that when we are about buying our mortgage, we need to watch how much we're spending. We need to watch how much we have in our accounts because these things impact how much they will be able to approve us. Say, for instance, you have a debt of, say, 100,000, and you want to take a mortgage of 600,000. Definitely, they will deduct that 100,000 that you are owing as against your income also. If your income can take up to the remaining 500, if it cannot, then it reduces the amount you'll be qualified for. By so doing, it will impact us in a way that your dream home or the home you want to buy, you end up finding out that you are unable to achieve it because of the debt you have. So, mortgage lenders assesses borrowers' debt to income ratio to determine their eligibility to manage additional debts. DTI means debt to income ratio, so your debts over your income. It's compared with your monthly debts to your gross monthly income. So typically, the lenders have a maximum DTI threshold, and exceeding these limits may disqualify borrowers from obtaining a mortgage or result in a higher interest. So this is where you see when a lot of us go for mortgage application, and we find out that we don't get qualified, what happens? Some people move to private lenders, and what happens? They take advantage of you by giving you a very high interest, which is not healthy for you. So that's why we need to have a very effective debt management by reducing our credit balances. So whatever amount we are owing, is it car loan, is it credit card, any kind of thing, just try to limit those expenses if you have any plan buying a home. I will give you my own example. Before we bought our home, I basically told my wife, I said, you know what, we're not buying any brand new car. So we had an old car. All because we don't want anything that will impact our dream home. And at the end of the day, we were able to get that dream home that we're actually looking for. So when we got that home, that was when, I think 2 years down the line, was even when we bought our very first brand new car. So I will encourage us, if you have plan of buying your first home, try and manage whatever car you have. Try to manage your debt. It's just a temporal thing. But by the time you get your home, which is an asset, you understand? The asset you can build from your home can even buy that car and even pay off that car. You understand? Because car will keep devaluing, but your home will keep appreciating. So those are the things we need to put into consideration when we are buying a home. So the other part that my colleague had earlier said, it's our credit score, how it impacts us. So when we look at our credit bureau, we'll see that a poor credit is seen from 300 to 579. Fair credit is rated from 580 to 699. Good credit, it's 670 to 739. And excellent credit, you can see it from the slide, that is from 800 to 850. For you to qualify for a very good mortgage, you should be looking at you being between that 670 to 850. Anything within that period, then you can hit your chest that, yes, you're going to get a very good mortgage. Also put into consideration, this has to do with yourself and your spouse. It's not just you, because both of you, they would need to put those into consideration. So if your spouse has a very poor credit, it might impact your borrowing capacity. Then, how the credit score is being rated. So debt management significantly influences credit score, which are crucial factors in mortgage approval. Payment history is one key factor. How far do you pay your credit? So most times we're owing our credit card and they will tell you just pay minimum of $10. And most of us take advantage of that and say, oh, it's just $10 and you're paying $10. That's not healthy. It's not helping you. And how long you've held your credit card, it's also a very good factor. If you've held your credit card for, say, 5 years, 3 years down the line, they cannot look at the history. How much have you been paying your credits? How much have you been paying your debts? Have you been constantly paying it every month, or have you been defaulting on month-to-month basis? So if you've been defaulting, definitely the lender will be looking at it that, oh, there's possibility of you defaulting in your home mortgage. So credit utilization, like she earlier said, if possible, 25%. That being said, if possible, if you can, even if you're spending, say, 60, 70% of your credit card, as long as you pay it back within that 30 days window that they give to you, it will not impact you. Every bank reports their credits on monthly basis. So if you have an idea what date your bank reports it, say, let's say, for instance, you have a CIBC or RBC credit card and they report on the 15th of every month. If you're able to pay back that money by, say, on the 12th of the month, before the 15th that they will be reporting it, they won't see that you have actually spent more than that amount that you're supposed to spend. So we need to put those dates in mind and work on it. On the other hand, responsible debt management, such as making timely payment, like I earlier said, maintaining low credit card balances can improve your credit score and enhances your mortgage eligibility. So now where our borrowing capacity comes, like I earlier said, it highlights your debts over your income. So they want to see what are you approved or what you can be approved of. So usually no lender, even we as individuals, if you come to meet me to lend money, I will need to know if you have the capacity to be able to pay me back. The same way the bank sees us. So for instance, if the bank says, okay, let me try this individual with 100,000 and see how much he's able to handle it. But I also need to look at, is this individual able to handle that 100,000 and without affecting other things in your lifestyle? So effective debt management. So when we're looking at effective debt management, it directly impacts our borrowing capacity, the maximum amount that can be borrowed to purchase a home. Another thing that lenders look at is they consider various factors including the income, your debt to income ratio, credit score, the existing debt obligation. So no matter all the debts you have, they put those things into consideration. Our student loan, our car loan, and other debts that we have, those things are put into consideration when we are borrowing money for our mortgage. So by managing our debt effectively, borrowers can optimize their borrowing capacity, increasing their chances of securing a mortgage with favorable terms. So when your credit score is good, like I earlier showed you in the slide, you'll find out that you will have better chances of you having a better terms and conditions. Then you are more like the one, dictating the price for the bank. That no, I will need this rate, and by so doing, you'll be able to negotiate a better rate. But if your credit score is very low, you'll be at their mercy, asking them for anything, and to the extent of you even going to a private lender where they will be charging you a very high rate. So, TDS that she was earlier explaining, it's total debt service ratio. These are financial metrics that the lender uses to assess a borrower's ability to manage their debts, to manage their mortgage payments and other debt obligations. These ratios are important factors in determining mortgage eligibility. So when we look at our TDS as against our gross debt ratio, I will be showing us how those calculation is being made. So for the gross debt service ratio, is a measure of a percentage of the borrower's gross income that is needed to cover your housing expenses, including mortgage principal and interest, the property tax, eating expenses, and 50% of condo fee if you're buying condo. So remember, when you're buying condo, you have to pay condo fee. So these things are things that they need to put into consideration when you are borrowing this money. So to calculate your gross debt service ratio, your monthly housing costs. So by the time you total all your monthly housing costs, you divide it by your gross monthly income, multiply by 100%. If you take a calculator, you all know what your monthly housing cost is. You divide it by your gross monthly income, then multiply by 100%. That gives you the percentage. So lender generally sets the maximum GDS threshold, which are usually between 32 to 39%. So if you take your monthly housing costs, divided by monthly income, and you are able to get between 32 to 39%, then you know you are in good hand. But if it's above, then you will need to work on your GDS. So borrowers with GDS ratio above these limits may face difficulty getting approved for a mortgage or may qualify for a smaller amount. Say, for instance, your plan is to buy a home of $900,000. But because of this GDS, your percentage is above 39%. What happens? The borrower will only tell you, oh, sorry, we can't give you 900. We can only give you 600 or 400. By so doing, you are unable to achieve your dream home. So we can all go home and get this calculation done when we are planning to make our purchases. So the other aspect of the calculation is the total debt ratio. On the other hand, this is a measure of a percentage of the borrower's gross. This is required to cover all your debt obligation, including your housing-related expenses, as calculated in the GDS, as well as the recurring debts as credit card, car loan, student loan, and every other personal loan that we might have. So we need to put all those calculations into consideration whenever we're going for a mortgage. This also goes with our second mortgage. I know my colleague will be talking more in details about that. So the formula for calculating the TDS is this. I earlier gave you the GDS. So for the TDS, so those are the two major things that the bank will be, or the broker will be looking at when you want to borrow your mortgage. Your GDS and your TDS. So for the TDS, it's your total monthly debts payment over your monthly income. So let's say your monthly debts, it's That includes it could even include your grocery payments, your credit card payments, any kind of payment that you have on monthly basis. You divide it by your gross income, then multiply by 100. Whatever percentage you have to be between 40 and 44%. Anything above this 44%, definitely you may be in a very tight corner for approval. So both the GDS and TDS are used by the lender to assess borrowers' financial capacity to manage mortgage payments and other debt obligations without being overly burdened by debt, because they don't want to a situation whereby they lend you money that you'll be struggling to pay. So you find out some people get into debts because they're unable to pay. Because even if you lie about your income or lie about any kind of thing, it's at your own detriment. If one is unable to pay, what happens? Then they put that house into foreclosure. You'll definitely lose the entire thing. And if they sell off that house and you're still owing them, they will still come after you. So let's try as much as possible to see how we can build our investment, build our income to help our TDS and GDS. So the impact of our GDS and TDS, the lower your GDS TDS ratio indicates that the borrower has more disposable income available covering living expenses. So what does that mean? So if the borrower is able to borrow you $500,000 for your home, they know that you are able to pay that money and still have something to live on. Your food, your grocery, your kids' school fees, your clothing. They don't want to put you in a very tight corner where you are unable to live your normal life because you bought a home. And that's why you see some people saying they have a home but they are not sleeping in it because they keep working from morning to night. But they don't want you to live that kind of life. They want a situation where you have a home, you can always go to your work, come back and lie down and relax and have rest of mind. Because things like that can also kill. Because when we are all worried about our debts, this can be a very big impact on our life. It can affect our health. So these things are things that we need to really, really look into when we are considering our mortgage. Additionally, understanding this ratio can help borrowers assess their financial situation and determine how much mortgage debt they can comfortably afford. So at times, let's not push ourselves too much. If I can afford a mortgage of $300,000, let's go for that $300,000. Like she earlier said, it's our starting point. Let's not say, oh, Patrick got a house of $800,000. I will also get the same thing. You might not be in the same TDS and GDS. There might be other things Patrick might be doing to make more money. So these are things we need to put into consideration. It's not a competition. But it's better when you have what you can afford. At the end of the day, you'll be able to do what? Go home, sleep, and you will not quarrel with your husband or your wife because they are unable to meet up certain obligations in the house. Please, let's put that into consideration. No matter how much prayer we pray, if we do not put all these things into consideration, it will not work. You understand? Everything has its own place. But with prayers, if you start with even 300,000 mortgage today, I can guarantee you tomorrow, I've seen many people who started with 300,000, 500,000, and today they have 2-3 houses because they've been able to build equity on that first mortgage. They pull out the equity from that first mortgage and they bought the second home. From there, they bought the third home. And now they are living happily. And these are the things I need each and every one of us to put into consideration. In conclusion, managing debt effectively is essential for mortgage eligibility because it influences the key factors such as the DTI, credit score, and borrowing capacity. By maintaining a low debt level, making timely payments, and improving credit worthiness, individual can enhance chances of qualifying for a mortgage and securing a favorable terms. So I encourage each and every one of us to please, whenever we are doing anything that has to do with debt, even if it's car, if you can afford 2015 car, just go for it. Don't worry about 2024. A time will come where you will. You understand? There's time for everything. Let's not put ourselves in a very uncomfortable situation where we'll be running helter-skelter. It's advisable for us to go for what we can afford and don't bother about what this person is doing. If you can afford living in the east, go for east. If you can afford living in the south, go for south. If you can afford living in the north, go for north. It's advisable for us to do what we can. It's not a race, it's not a competition, but at the end of the day, we'll have rest of mind. Thank you very much. So, Patrick, please.
Hi, good afternoon, everyone. My name is Patrick, and I wouldn't want to take much of your time. So I'll be taking you through, for those who already have a home, I'll be taking you through the renewal and the refinancing process. It is critical for us to understand that for those looking at renewing or refinancing, one key thing I always tell them is there is a need for you to always run your numbers. Get to know what your finances are saying and speak to a broker. Now, what exactly is a renewal? Now, a mortgage renewal is when you work with a broker to structure a new mortgage contract. Renewing your mortgage is an opportunity for you to make some important decisions, especially when it includes payment frequency, trying to understand the need for you to switch lenders, or whether for you to go for a fixed or a variable rate. And preparing for a mortgage renewal ahead of time can help you to secure a better interest rate for the remaining amortization. Now, a lot of people tend to confuse renewal with refinancing, and it's critical for us to, break that down for you guys. Now, while we know that a renewal is an extension of a mortgage contract, a refinancing is breaking of your mortgage contract and signing of a new one. A refinance allows you to secure a lower mortgage interest rate if rates have fallen significantly, and I'm going to stress that for you. If rates have fallen significantly before the end of your term, and an ability for you to use your home equity to, build on more renovations within your house, debt consolidation, or for you to use that same equity for some form of investment. Now, as much as it is critical for us, especially for those whose houses are coming to the end of term and the need for them to renew, it is also essential for us to understand what happens and when it happens when it comes to renewal. The mortgage renewal process isn't that complicated. Your current mortgage lender presents you with a new mortgage offer. It's either you sign it, you negotiate it, or you seek other lenders via your broker. When is the best time for you to seek a mortgage renewal? When is the best time for you to do your mortgage renewal? It is advisable that is always at the end of your mortgage term. And you work closely with your broker who would assist you in working with various lenders to get that preferred interest rate that you're looking for. So when should you start the mortgage renewal process? We always say as soon as possible. This will give you more time to compare mortgage rates across different lenders. And why am I basically saying this? I'm saying the beauty of you working with a broker, and just like Abibat said, is that we have over 40 lenders that we work with. And for you looking at renewal, it is critical that you play along with the numbers, review the rates that work significantly well for you and in line with your finances. Some lenders suggest renewing this process up to 4 months before your renewal date. Some may let you renew your mortgage up to 6 months early without charging you what we call a prepayment penalty. So, what exactly are the key things you have to look for when you're renewing or when you're having these conversations with your broker? One, the renewal statement outlines the following: the remaining balance of your mortgage, the interest rate with specification that it won't increase until the renewal date. What exactly would be my payment frequency? what will be the terms of my new agreement, and what will be the charges and the applicable fees that would, apply. Now, there is a caveat that I'm putting underneath there, and I need you guys to understand it as well. I was saying that some lenders will automatically renew your mortgage if you don't respond to the renewal offer before the date. So it's critical that when you are practically going for a renewal, please respond to emails being sent to you by your lenders and ensure that you have this conversation with your brokers when you're trying to renew. Where can you renew your mortgage? So we have practically two options. One, some would say, let me go back to my current lender. But for others, I'm talking about 80% of those who have practically renewed houses, they always seek new lenders by consulting with brokers because it's all about the interest rates. It's all about the numbers. And when when you're renewing, it's critical, like I've mentioned, that you assess your finances. Review what comes in terms of income and what goes out in terms of expenses. You would also, when you are renewing, seek for things you want to add to your property. So there's a need for you to assess your mortgage features. Renewal can be an opportunity for you to make other adjustments to renew your mortgage to make it far more manageable. You might decide to increase or decrease the frequency of your payments or switch from a variable interest rate to a fixed interest rate. Doing your renewal is also an avenue for you to use your prepayment to reduce the number of times or the length of years you practically would want to pay in terms of repayment. So use your prepayment to reduce the principal before you renew. It is always a good idea to try to reduce your principal as much as you can before renewing. And lastly, I would always stress it, negotiate. And this is where you have to have that conversation with your broker. The need for you to go through the documents, the need for you to access every other activity that you need to go through when it comes to renewal, and then especially when it comes to the interest rates, review what the different lenders are offering to you. There are many reasons why your mortgage payment might change at renewal. And if your mortgage rates have shifted since the beginning of your last mortgage term, your mortgage payment is likely to change based on the new rate your new lender is offering you. So here I will talk about refinancing. And like I made mention, there's a major difference between renewal and refinancing. A mortgage refinancing involves breaking your existing mortgage contract and paying the current balance in full by securing another mortgage loan. This new loan comes with its own terms and conditions, including the different interest rates that you might have had with your previous mortgage lender. Refinancing, again, can be a very, very beneficial move if it is timed well and done carefully. So what are the basic things that they would want to see when you're refinancing? Or what are the activities that will be done prior to you refinancing? One key thing is they would basically schedule your home for an appraisal. They want to know exactly the equity in terms of the value, the market value of your home. What is the current value? What is your income? What is your debt service ratio? And what is your credit history? There would be a proof of identification that would be requested from you, a proof of employment and income, your tax documents, details regarding your assets, savings, and debt. Now, there's something called a stress test that they would have to put you through because you are refinancing. And it's critical that you understand all this prior to you taking that decision. The rate you will be stress tested at, also known as the minimum qualifying rate, will either be at 5.69% or the rate the lender is offering you plus 2%, whichever is higher. Now, when refinancing, it is important for you to do some comparison shopping. I've made mention of that. You need to have that conversation with a broker. What is lender A offering me? What is lender B? What is C? What is D? What is E offering me? The decision has got to be yours. But you have to understand how it's going to, apply to whatever it is you have in terms of income or whatever it is you're incurring in terms of expense. Now, when refinancing, it is important for you to do some comparison shopping to ensure that you're getting the best rates, terms, service, and conditions. You don't have to refinance your mortgage with your current lender, so it is best for you to compare several before deciding which one presents the best deal for you. Again, what are the reasons why we refinance? Two major reasons. One, to secure a lower borrowing cost. And then two, to free up cash. Cash that we might want to use for home renovation, for an investment property, for a child's education, to start a small business, or for debt consolidation. And how much can you borrow? Now, I made mention that there's always going to be an appraisal of your property first. Once they get that market value of what your property is right now, you can access 80% of that market value. So a mortgage refinance is often a way for homeowners to access additional cash. The amount you can borrow using your new mortgage is determined by how much home equity that you have. So an example that we have up there was saying if your home currently is valued at $500,000, then 80% of that $500,000 is $400,000. Now, bear in mind that you're refinancing, meaning you're trying to switch from a lender A to a lender B. Now, if your outstanding balance from your current lender is at $350,000, it means that the $400,000 that you're accessing would be used to pay up what you have with your lender B, with your lender A, and then the $50,000 access is what you have in terms of equity. But when we are looking at what you're now owing in terms of the refinancing, it is now at what? $400,000. Now, I would have to stress this out for you, that if you are considering a mortgage refinance, be sure to budget for all possible costs that will be involved. We're talking about legal fees, transfer fees, home appraisal fees, and your mortgage discharge fees if you decide to change lenders. Now, when is it great for you to refinance? So here we're saying, because you're paying off your mortgage early, your lender may charge what we call a prepayment penalty to refinance. But to minimize this, the ideal time to refinance is generally near the end of your mortgage term, especially if you have a closed or a fixed rate of mortgage. Now, there are critical questions you always need to ask yourself when you're having conversations with your lender, especially when it comes to refinance. I've been able to identify these questions, and it's critical you have that conversation before you make that decision. One of them is, what is my existing mortgage rate versus my current mortgage refinance rate? Second one is, what is the legal and the closing costs, especially when it comes to appraisal? Am I going to be highly geared in terms of the interest debt that I will be accruing? And how much is the penalty cost if I decide to break my mortgage before the end of term? And lastly, this is a personal question. Would refinancing improve my lifestyle? So these are questions you need to ask yourself, especially when you're having that conversation with your broker before deciding. So what exactly are the pros and the cons of refinancing a mortgage? Say one of them is saving money by getting a lower interest rate, freeing up cash flow by arranging smaller monthly mortgage payments, accessing funds that can be used on major purchases or debt consolidation. For the cons, we're saying you might wind up with a longer mortgage. You might have to pay penalties on other fees, and there might be a need for you to pay a higher interest rate than if you have waited to renew. But before I leave, I would like to give us a bit of words of wisdom. And it says, that do not run when you're supposed to walk. Do not fly when you're not supposed to run. The aim of a refinance or a renewal is for you to, first of all, access and run your numbers, speak to a broker, and let them work together with you in getting that property that you so desire. Thank you.
Thank you so much, everyone. Okay, so I'll just be taking you to the aspect of the investment. So we won't talk too much about this, but so looking at investment, everybody wants to invest in real estate, and everybody wants to invest in real estate, which is part of. Some people will start, like I said earlier, a starter home, and later to a home that their dream home. A starter home can be like a rental property later, but it depends on another thing. Will your income be able to shoulder the two mortgages? So when you're looking at a rental properties, it's an opportunity, when there are some parts that if you can do it yourself, it helps, because you want to try as much as possible to save at the same time you want to invest, right? So doing some parts of the probably like do-it-yourself skills. I usually tell people, I said, even going to YouTube, apart from doing an investment property, even in your own home, it is ideal to maybe a little tool, you can do it yourself instead of calling people to help with some of the things in the home. So owning a rental properties can be a great opportunity for individuals who have a do-it-yourself renovation skills. And again, and the patient to manage tenants. So you have to think of so many things when you're investing. The people you want to manage and the property itself. So, however, these strategies does require substantial capital finance upon maintenance costs and to cover vacant months. If you don't have a tenant in that month, you will be the one to shoulder the mortgage, no matter what, because you still have to pay, right? So that you have to see to yourself and talk to your partner and said, is this actually something we want to do? Can we do this? So it's a question to ask, not just people who are doing it and I want to join them in doing it. So it's very important. And when you're doing a rental property, so this is the thing, if you're not going to live in that home, you've bought your house already, and you want to get another property, which you are not going to live in that property. So the lender requires it to be a 20% down payment. A house that you're going to live and sleep, that you can do a 5%, even though you've gotten a 1 already. So the first one you got, it's going to be, the other one will be like you are upgrading into another home. It won't be as if it's a rental property. So you can have property 1, that is our starter home. And you move to property 2, that is our dream home. And you want to leave property 2 to move to property 3. Property 3, you can do as low as 5%, because that is where you're going to stay. So the other 2 houses will be like a rental property. That is if your income, household income, can shoulder it. So, and another thing, by the time you have 1 home, the 2, we can use the income from that property. Some lender can use 50%, but few, I think just one lender can use 95% of that income. So that will be added to any of the house that you want to buy. So investment property, rental property, trust me, it's ideal if you have the income. Then you have house flipping. You can buy a house, maybe a house worth of 100,000 or less than 100,000. Knock it down and rebuild again. If you look at around like St. Mary's, that has been going on like that around St. Mary's. They will just buy a lot. Maybe the lot is around maybe 6,000, 5,000 square footage, I don't know. And they will build a different 2-story building in there. So that is another way of flipping. And flipping means that you want to sell, you can do the flipping below like less than a year because it's what you want to buy, sell, rebuild, and just sell, right? So you want to buy, renovate, and resell. That is the basic of a flipping. Like Patrick said, home equity. You can pull money out from your home equity, yes. He said that. You can use it to offset some debt, or you can use that amount to buy another property. You will use that as a down payment. But for you to use it as a down payment, you have to access the money first and put it on another property that you want to buy. So it's not as if you want to do it like a transfer from it to. So for example, of a loan to value, 80%, they can go by only 80%. The property value, like he said, there's an appraiser that came up and said the appraisal value right now is 850. And they can only go by 80% of that 850. And what is 80% of that 850? That is 680. The remaining balance on your mortgage, let's say around 550. The amount you can take out, you can sometimes, it depends on the lender. You can take out maybe around 100% of it, but some people want like 80% of it. And again, it depends on how much do you need. If you don't need all, there's no point taking it out. Just leave it in that. You know that you have extra money in it. So it's not as if, oh, I want to refinance my mortgage, I want to take it all. If you don't have any tangible things to use it for, trust me, I'll just tell you, take the little you want and leave the rest in it. Just use whatever you need. And so looking at this example right now, so you know the takeout is 130,000, right? So 130, or maybe you just use 30,000 of it. So 30,000 will be added back on the 680. So that is not about I want to make use of it all, or I want to use it all. There's another thing we call HELOC, Home Equity Line of Credit. So I didn't have it on my slide, I'm sorry. So home equity line of credit, lender can go by 80%. If you do a 5% down payment, you cannot do an HELOC. Because for them to do an HELOC of 80%, they can only go by 80. Now, your HELOC might be, it depends on you, whether you want to use 65% on your mortgage or 15% on the HELOC, or vice versa. So that is how it works. It's only, I got that a lot. I want HELOC with a 5% or with a 10% or with a 15%. No, it's basically when you're doing, they can only go by 80% loan to value. So that will conclude our presentation for today. We just want to say thank you all for coming. We want to give you the time for question and answer because we know that you've already jotted so many questions for us. Don't put us in a hot seat, okay? Don't put us in a hot seat, but we'll try as much as possible to get as much as we'll treat your questions. So if you have any question for us, thank you so much for coming. We really appreciate your presence in here today. Okay, any question from anybody? Okay. So, quick one. If you have any question for maybe a lawyer or a rater in the house, yes, we have one that is sitting around the corner there. They can answer you because we don't know any much. We don't have a clue about it. So, any question?
Thank you very much.
Yes, sir.
Yeah, my question is about building up equity. So I want to know specifically if equity is a loan that you still need to pay back, and then how is it calculated if you've had a home before, and then maybe probably it appreciated. How is the mathematics being done, and you know exactly what the equity the house has been able to build? Thank you.
Thank you so much, sir. So looking at an equity is a loan because you're taking money out and they are putting it back because they're going to appraise your house. So by the time they appraise your house, that is the example I did. They appraise the house for 850, right? And they can only of refinancing. They can only go by 80%. But equity, for example, when you put a 5% or a 10% down, you don't really have an equity on the house. 10% you still have, but 5% you don't because CMHC has already consumed your everything by the time you want to do. So you're just left maybe 4,000 in a mortgage of 3,000. So there is no equity when you're doing a 5%, even for the period of your mortgage. But if your house has appreciated, yes, you can. So it depends on what the appraisal value says that you'll be able to, okay, I can do. Remember the time of COVID, people that bought a house around 450 and their house appreciated to around 550. Yes, even though they put a 5% down, then that house has appreciated already and they can put out money. So it's a loan. Okay, then I'm not sure whether, all right, sir, thank you.
Yeah, okay, my question is, how long, what's the minimum length to build a good credit score, for example? Does it matter? During one of the presentations, somebody mentioned maybe 3 to 5 years or whatever it is. Is that like a prerequisite, or you can do it after 6 months, 3 months, whatever it is, as long as you have a job and the gross income to cover it?
Okay, so when you're looking at credit score, you have to have one credit card in order to have a credit, because if you don't have any credit history, then there is no credit. So it can go by maybe 3, 4, 5 months. By the time you're using utilization of your card, will tells you that, okay, this can help. 1 year, yes, they are okay because they gave you maybe, for example, 1,000 and you manage it well. Now it will build your credit gradually at a time. So I don't know whether I've answered your question. It matters at least, maybe let's say start from 6 months. Yes.
I just want to ask, do you need to attain a certain status in Canada before you can buy a house?
Yes, that's a good question. So you can only buy when you have a work permit, permanent resident, or a Canadian. A student cannot buy a house. They used to do that, but they stopped it. And your work permit, it must not be less than 183 days. So if you have a work permit that is a year, expiring a year or 2 years, then you're fine. But and then another thing, they usually sometimes, it depends on how strong your income is, they might tell you put 10% down. I usually recommend 10%, but I'll work with a 5% if it's able to go through.
Hi, sorry. Someone is asking if you have a car loan of about $20,000, can you still buy a house if you have down payment of about $30,000?
It depends on the amount of property he or she wants to buy. Yes, you can, but it will a bit affect your total debt service You might not be able to get what you want, but you can still be qualified for something. So car loan for sure reduces application by 80 to 100,000, irrespective of how much remaining. What they usually check is how much you're paying monthly. Not that even you have 1,000 or 2,000 remaining, it's still the same amount you're paying because you're on a term, right? So that is determining how much you're paying. So yes, that person can still buy, but it might reduce what will be qualified for.
Hello, my question is about refinancing. So, when you're right before refinancing, can you pay a lump sum and then refinance with the same lender?
Yes, yeah, you can pay a lump sum and refinance. Yeah, for sure. But another thing is, if you're refinancing, you're going to pay penalty if you're breaking your term. Okay, so you want to see that if I'm breaking my term, how much am I? What's my penalty cost? You have to look into that as well too. But yes, you can put a lump sum into it and refinance it.
So how about for renewal?
Renewal, yes. Everything you want to do, you can do that. Renewal, you pay on your principal, any amount you want to pay, but you must not exceed. They will tell you you have 20% prepayment. You must not exceed that 20% for the year. If it's 20 or 15, depends on your product, right? So you can refinance or renewal, but you have to pay penalty if you're breaking the term.
And then on refinancing again, so if you refinance multiple times, does it negatively impact being able to get future mortgages?
No, it doesn't.
Yeah, if you are buying a new house, and most people prefer to want to do 5% or 10%. But if you want to do more with the principal and play around with it, maybe probably you're doing like 20, 25%. How does that affect your amortization of the monthly mortgage and payment?
So are you talking about the down payment?
Yes, of course, yeah.
So your down payment, your amortization stays 25 or 30. Now it's going to be 30 if you're putting 5% down in August, right? So it doesn't affect it. The only time it affects your amortization is if you're putting extra every year, or you are doing a bi-weekly payment, or you're doing accelerated bi-weekly payment. That can affect it. But if you're doing 25%, yes, that's fine. The only thing is it's going to reduce how much loan you required and how much your monthly payment or bi-weekly payment will be. Yes, and you're not going to pay CMHC. Yeah.
For the gift, wouldn't they require a proof of where the money is coming from? The reason I ask is I've had someone that needed to do a gift from a friend, and they needed to see a proof of where the money is coming from. Is that always the case? So a bank statement or something to show that where the money is coming from so they can trace it?
Yes. So some lender does. Some lender will want to see if they are not comfortable enough with it. They will ask for the person that is gifting. They will ask for the down payment of that or the bank statement for that. So most of the time, they usually have their form or their gift letter format. So sometimes they will tell you, go to your bank, and so that your bank can sign and say, this actually is in your account, right? But if they are not comfortable, yes, they will ask for the statement, and they will have to produce a statement, right? So it's lender to lender.
Hi.
Hi, sir.
What if you make a mistake by co-signing? What's the best way out?
Tell the person you have to let the person out of it. You have to take yourself out of the co-signing. Yes. So pay off the debt so that you can get out of it. Yes.
What if the person doesn't have the money to pay and you've already made the mistake? You've signed already.
That is really tough. That is really tough. You just have to get out of it. Yeah. I have someone that thinking that will be you are kind of stuck because you know the liabilities on both of you. Whatever you do, it's on you and it's on him. So unless you pay off the debt, then that clears it all. But if you're still within the debt, then you still like into it together.
Hello. Is it possible to buy a second property by 5% instead of 20%? How can that work?
Okay, ma. So the second property, yes, you can buy another property with a 5% if you're going to live in there. But sometimes you can do a 5%. If you have a current mortgage, let's say around 250, and you want to buy another one around 270, right? We can say, yes, we will switch to that house. Or, the house is almost the same range. Yes, you can do a 5%. Compared to when you now said, oh, I have a mortgage of 600 before, they will ask you, who are your dependents? How many are your dependents? And you now want to buy a mortgage of, let's say, 200. For sure, they will know that you are not moving into the 200. You need a 20% down payment on that because you are not staying there. But the house that you want to stay, yes, ma, you can do a 5% without no. But we can now say sometimes maybe you want to downsize and go into a lower property. Yes, because you're going to be living there. So you can do that. But if it's going to be basically on investment, then it's a 20%.
If my existing mortgage is up for renewal and I want to buy another property, like a rental property, and looking at what's the possibility of using your equity in your current mortgage, and is there a possibility of consolidating and knowing that you're paying whatever rent you're getting, pays off the other mortgage that you have running?
Okay, so now if I get you now, you have a current mortgage already and you want to buy another one and you want it to pay itself, right? So this is the thing, and you want to renew. You have to first renew, because if you did not renew your mortgage, there's something we call an open mortgage. Open mortgage will give you maybe an interest rate of maybe 7% because they didn't see you to come, right? That will go directly into an open mortgage, right? But you're renewing. You know you have a mortgage already that you have to service, and you want to buy another one, which you have a down payment and everything. Yes, it will pay itself, right? But you cannot consolidate the two together. It's different title. So it's not like you have, if you want to consolidate, you can consolidate your credit cards, your car loan. You cannot consolidate two mortgage payments together. So it has to be on a separate. If you have any question for a real estate agent, I think the lawyer just left. If you have any question on real estate, we have Ima.
Okay, someone
right here.
said, what's the advantage or disadvantage of paying 20% down when you have renewal or refinancing most likely changing bank?
Okay, 20%, like I said, you're not paying a CMAC. That's the advantage. And again, your payment is going to be lower. And you have enough equity on your house again. If you want to have or to pull out equity, you know that you have a money sitting somewhere that you can play with at any time or you can access at any time. Okay? So 5% for sure, below 20% for sure, you're paying CMAC. Even though you're doing like 19.99, you're still going to have to pay CMAC. So 20%, it depends, and it's their choice. So putting 5, 10%, 20%, it's their choice. What's in their bank account will tell them, right, okay, this is what we want to do. But 20% definitely it will reduce the amount of their monthly payments.
The question I'm asking has to do with when you want to change banks. Is it like you are at disadvantage when you have like 20% paid, and because they say you don't have like the what do you call it, the insurance? Does it count against you, like if you want to change your bank at the next, maybe you want to read it?
No, if you're changing your bank, we call something a transfer, right? And it doesn't really matter. So what matter is whatever you start with your mortgage, it's what you're going to continue with it, right? You put a 20% down, fine. When you're transferring, then they will look at it based on a 20%. So the only thing is the interest rate you're going to get, it's going to be based on a 20%. And it's different from, the interest rate of 5% is different from an interest rate of 20%. There's something we called I ratio. I ratio is 5%, and conventional is 20%. So it's different because why? You're not paying CMHC. So they will get you somewhere. Canada is win-win. No, you have to win here, you lose here. So right here, because there's a 20%, they believe that you have enough equity or enough money at hand to put down as a down payment. So it doesn't really matter. If you're transferring based on the 20%. If you're transferring as a 5%, you transfer on a 5%. And you will still, because you're under insured program, if you are under CMAC, they will still look at the application based on a CMAC application. So they won't see it as, because you want to transfer to another lender, then it's going to be on a 20%. No.
So when you are being evaluated, like for your income, let's say you have two jobs, one is salaried and the other is contract, would both be considered or just one of it would be considered?
So they will consider both. One is contract, one is salaried. Contract, you have to be 2 years on the contract, okay? Because they see that as a self-employed. Is that what you mean, sir? Yeah, they see that as a self-employed. So it has to be contract. It has to be 2 years. Then term, it has to be 2 years. Then salaried, we can use the whole income of your salary income because that is a full-time already. But if you have 2 full-time jobs, you have to have 2 years history on both full-time jobs. Because they said it's not, what is this? They have their name that they said is not... I can't remember the language they usually do. They usually say about it that you need 2 years history for your 2 full-time jobs. But if you have one part-time or part-time permanent and one full-time, yes, you can use it. If you have ordinary part-time, they need 2 years. If you have casual jobs, they need 2 years. So salary, self-employed, it's always 2 years. For the 2022, 2023. So that's what we needed.
We've got a question on YouTube.
Okay.
So a person said, what is the average of these other charges for refinancing mentioned when discussing the amount left when refinancing?
Okay. So there is when you're looking at refinancing, there is all the fees that will be charged by the lender, like the application fees that will be needed. Application fees and what again? And transfer fees that needs to be, but it depends on lender to lender. But the amount is based on lender to lender. Any other question?
Yeah, thank you. I just want to clarify between mortgage specialist and mortgage broker. So
It's the same.
it's the same, yeah.
Mortgage specialist, mortgage broker, mortgage professional is the same. Yes. If you want one, we are here.
Hi, thank you so much. So, sister, I know you are a mortgage broker. If I'm going to need your services, is it based on percentage of how do you charge your fees? Because I'm not sure whether I have to pay you or. And aside from that one, is there a lawyer in the house? I want to know, when does the work of a lawyer end? When does it end when it comes to like buying a house? Because at times when you close and you notice that there's still some things that the builders said they were going to do that they didn't do, can the lawyer still reopen it, or can you still go back to your lawyer after you've closed?
Yes, thank you so much. I've been expecting that. Is there a charge for a mortgage broker? So there are a couple of lenders that we use. We call some A lenders, B lenders, we have alternative lenders, and we have the private lenders. So it varies, and it's case by case. It depends on your application. If you're taking your application to A lender, B lender, you pay a broker $0. You pay no fee. But if we're sending your application to alternative lender or a private lender, then there is a charge, depending on in between 1% to 2%. It depends. So it depends on what your application says, because you see some application and it will be like, really? So this will have to be private lenders, alternative lenders doesn't pay us. So that is why we have to charge the buyer a fee. So when you, unfortunately, I think lawyer just left not quite long. So I think you're right. You can access your lawyer at any time. If there is anything that needed to be done in maybe outstanding, please feel free and reach out to your lawyer, because they are the intermediary between you and the builder and the builder's lawyer. So you are free to reach out to your lawyer at any time, because brokers, by the time we're done and your application has been approved and every condition has been met, they took us away from the application already. So you are now, you cannot even call me. You can call me and I will explain to you, okay, this, but I won't really give you what you want to hear from me, because I will not have any access to your application anymore. So immediately we're done with your application, then the lender will just take you over from us. That is when we now move to the next person.
Sorry, I'm going to ask this again. So when it comes to all those warranty that the builders promise you, like the 1 year, 5 years, 10 years, 8 or 10 years,
right?
Like the 1 year bumper to bumper, or anything happens, then you can go back to. But if they've taken you out, who do I go to?
Oh no! So the lender took us out. We don't deal with the lawyers. So the lawyer, we don't deal with builder directly. The only thing we have to do is to get you approved, which we've done our home part. Is the financial aspect of it that we do. So at the end of the day, the lawyer will be the one to have access to the builder's lawyer. So the communication will be between yourself, your lawyer, and the builder's lawyer.
So if you go with a realtor, so how does the realtor now?
So we have a realtor in the house. Maybe you can explain to us, please.
How does the realtor help if you want to, like, okay, I need to claim this?
I understand your question, sir. So when it comes in terms of the warranty, you can deal with the builder's warranty departments. You understand? They have a department where you can easily call them. It will have been in the binder that they gave to you when you build their home. If they are not responding, you have the right to call the city. City will call them. So I've had that experience when we built our home. So there were a couple of things that we didn't even know they were supposed to do. Many years down the line, all of a sudden they just came to our home and said, hey, there's something we need to fix in your house. I said, what are you fixing? Everything is okay. And they said, no. City said they cannot close our file until they... So it's usually between yourself, the builder's warranty department, and the city. So if the builder is not coming, you can call the city. The city will definitely call them. You understand? So it's usually not between even your lawyer, the realtor, or the mortgage broker, but it's between you or the warranty department. So every builder has a warranty department. So usually they come within 1 year of building your house to come and fix any damages like crack and all that. So they will tell you after 1 year, after they finish building your home, they want it to settle. So a year later, they will come in, all those crack, they will fix everything. After they fix it, a couple of other things has 5 years, 3 years, your driveway and all that has their warranty. If you have any issue, there's a binder they give to you. If you go through that binder under their warranty, just email or call their warranty department. They will get in touch with you directly.
Okay, thank you.
To the... you can.
Exactly the same thing he said. But usually some people go back. So if you have a realtor that helped you in the process, sometimes it's easier to go back to them so they can help you because they know who exactly to talk to and who to fight for that for you. So usually it's easier for people to go to their realtor.
Because I know some in a situation whereby the builder will be like, oh, it's over a year, so
yeah, so
you haven't.
So that's why it's easier to go back to someone that knows who to talk to and how to go from there.
So this has to be done before it gets to that 1 year?
Don't know. It depends on the contract. There are contracts, so there are forms you sign. So every warranty has different years. So if you have a contract of warranty for 10 years, there's already a binder that states what's covered in that 10 years. So it depends on what the issue is. So let's say you have an issue for furnace or so. If it's less than 2 years, I know furnace would be more, but if it's less than 2 years, after 2 years, you really can't claim it. So it depends on what's in the contract and how many years it's covered. That's when you can then work on that. So it's always in the contract. If you're not sure, the first step is either to talk to your realtor, the lawyer, and then you'll be able to proceed from there. So whenever you're not sure, always ask.
Thank you.
Do we still have any question? Okay.
Thank you. So we have a question from YouTube. Which would you recommend, getting a mortgage or staying on rent? What are the few advantages?
Well, for me, I would say it's an individual thing. To be sincere, I would rather say get a mortgage. And the reason why I've seen this, I've heard these kind of questions in the past years where people say, oh, it's easier or cheaper for them to rent a home. But one thing you should understand is whenever you are renting a home, what you're technically doing is you're building another person's wealth. You're not building your own wealth. You understand? But anytime you're paying down your mortgage, you are doing what? You are investing. You are increasing your wealth. You understand? So when you keep renting my house, so if you prefer renting, please, I have space for you to rent. So you can help me to pay my mortgage. However, if you have your own home, you are building your mortgage, your investments. Look at it this way. If you have a mortgage of whatever amount, let me say 500,000, and you're paying down to it, say 5 years down the line, all the amounts you've been paying, not all, but minus the interest, the principal that you've been paying is more like your savings. These are where you can get your equity that you can pull out to even buy the second home, to pull out to even do any other thing you want to do. You understand? But if you're paying a rental apartment, what do? You're basically doing the same thing for that owner of that apartment. You're paying them so that they can use your money to buy another rental that you will bring your brothers, sisters to come and continue renting. So I wouldn't encourage that. So in my own little way, I would say it's good for you to look forward to save up money, buy your own home, no matter how small it is, to start from there. That's my own advice. Okay. So in absence of any further questions, myself and my partners would like to say a very big thank you to CAC Vineyard of Comfort for giving us this opportunity to give you all this information. And we have our cards, our complimentary cards at the back of the church. Please, if any of you have any mortgage questions, if you see me in church or anywhere outside, or my two other colleagues, kindly reach out to us and we'll be glad to help you. Thank you very much.
Trying to live without any water, was trying to